Hey guys, so when it comes to financial IQ, it comes down to four things. Number one, the ability to read numbers, which is accounting. And number two is investing, which is the science of your money making money. Number three is understanding markets, which is the science of understanding supply and demand. And number four is the law, aka understanding taxes. And that's what I want to focus on today. Capital gains, what they are and how they affect you. And of course, as always, welcome back to the channel guys. It's me, Adam, and you are watching Steady Invest. If you haven't already and you're new to the channel, subscribe down there, like, and drop a comment. Let me know what you think. Capital gains refer to the profit that you make from a sale of an asset. And this doesn't just relate to stocks either. This could be from real estate or bonds or whatever investment you've made. The way capital gains work in Canada is much different than how it works in the States. In Canada, you only include half of your capital gains in your taxable income. For example, if your salary is $100,000 a year, and you sell a rental property for $20,000 more than you originally bought it for, your taxable income for that year would be $110,000. And it doesn't matter whether you bought that property yesterday or 50 years ago. It's treated the same no matter when it was purchased. In the US though, it's completely different. The full amount of short-term capital gain, so anything that you've been holding on for less than a year, is taxed as if it's regular income. Long-term capital gain, so anything you've held on for more than a year, are taxed at a lower rate than regular income. But that amount depends on your tax bracket. Unfortunately, not every investment goes the way you want to, and sometimes you have to sell for a loss. There is, however, good news because capital losses help produce capital gains. In Canada, if your capital losses one year are more than your capital gains, you can use that amount to reduce your capital gains from the past 3 years or any future year. In the US, capital losses can reduce capital gains in up to $3,000 of regular income. But if your losses are more than $3,000 more than your gains, you can carry it over for future years to reduce capital gains in the future. As you can see, it's possible to strategize around capital gains. And if you're making a strategy, that means you're using logic. And with logic, you make good financial plans. That's why it's so important to know the law, and you can't ignore it because the taxman will come after you. And that's pretty much it for my video, guys. If you enjoyed it, if you learned anything, let me know in the comments. Make sure you like, you subscribe, and I'll see you in the next video.